What's up everyone, my name's Robbie, this is Robbie Manila, and today we're talking about Alphabet, aka Google, and whether or not the stock is a buy. I do want to hear from you in the comments below. I'm trying to name the system, so here's what I'm thinking. I'm thinking of calling it the RIM rank or RIM rating. I don't know, I was thinking that would be kind of cool, but let me know what you think in the comments below. Trying to figure this out, or if you have a suggestion, let me know about that too. So as a stand-in, I'm just gonna call this the RIM rating today. So for our RIM rating, this is what we're going over. First, we have what I call the Rolex score, which judges quality and trust. Next, we have an industry-based valuation. Then we have an industry-based profitability, also an industry-based growth score, and finally, a liquidity score. We add all these up and we come up with a ranking. Now, I'm still going through stocks, trying to understand the system that I created, and I think that over a 70% is gonna be good and under 70% is gonna be like, I would stay away from. But after we go through the RIM rating, then we're gonna go through a discounted cash flow, then we're gonna talk about technicals. So let's go ahead and let's get started. So we're gonna put Google through this analysis, figure out if it is a buy or not. But I do wanna ask you a question. Leave a little comment below, let me know if there's any specific stocks that you think you'd like to see me put through this system. I'm still testing it, still trying to figure out if I need to make some tweaks. So let me know if you wanna see anything specific. So we got the spreadsheet open. Let's go ahead and analyze Alphabet, aka Google. And the first thing to know is there are two different share classes. So ticker symbol GOOG and GOOGL. I'm going over GOOGL. I just randomly, no reason particular that I'm gonna pick GOOGL. I just am. Those are the C shares, so you know. Generally, it should be pretty much the same thing. Now let's quickly go over what Google does. I mean, just in case you live under a rock and you have no idea. So Alphabet Inc. provides online advertising services in the United States, Europe, Middle East, Africa, Asia, Pacific, Canada, Latin America. The company offers performance and brand advertising services. It operates through Google Services, Google Cloud, and other BETS segments. The Google Services segment provides products and services such as ads, Android, Chrome, Google Maps, Google Play, Search, and YouTube, which is what you're watching this on now. I'm not gonna go through the whole thing. I think you get the idea, you know what Google is. So let's go ahead and get into the spreadsheet. So the first thing we do when it comes to a RIM rating is that we go through the Rolex score, which is what I call quality and trust. So there are two factors here that I use to help me figure out if a company has both quality and trust, just like a Rolex timepiece. So the first thing is called Piotroski F score, and the second thing is the shares outstanding. What we want is for shares outstanding not to be going up. If a company is issuing shares, it's diluting us, which we don't like. So let's take a look and see what the Piotroski F score is. So as you can see, I have written here that the Piotroski F score is an 8 and the shares are decreasing. It's exactly what we want to see. Now, why is it an 8? Let's quickly take a look at Guru Focus to see Piotroski F score. So Piotroski F score is a score from 1 to 9. You get a point for every positive thing you have. So Google has a positive return on assets. It has a positive cash flow from operations. It has higher return on assets than it did last year. The cash flow from operations are more than the return on assets. Leverage is lower year over year. They don't have a higher current ratio year over year. So that's the one thing that they got a negative on in this. They have less shares outstanding year over year, which is the other thing that we take out. And we break out specifically. We have higher gross margins year over year and higher asset turnover year over year. So as you can see, Piotroski F score gives us a score of 7, 8, or 9 is very good because you have a lot of these very important factors that you're getting check marks for. Why do I specifically include shares outstanding when it's already part of Piotroski F score? Well, I just think it's really important, so I give that some weighting too. So if you have a F score over 7 and you have decreasing shares outstanding, you get a 5 for each of these categories. So this is a 10 out of 10, 100% Rolex score. So far, Google's doing pretty well. Let's go to the next factor. So next we're going to an industry-based valuation. And the industry part is the important part in this one because I don't believe as an investor that just picking a certain metric works. Some people will tell you not to invest in a company that has a PE ratio more than 25. Some people will say don't invest in one more than 15 because they're serious value investors. Some people say 30. Whatever it is, I don't believe in that. I think that you should base it on the industry and the peers of the company. So that's why when I did this, I wanted to make it so that it goes up against the industry's average. So the actual PE ratio of Google is 23.93 and the industry average is 77.27. So it's got a way lower PE ratio than its industry, which is a check mark in my book. So I'm looking here is I don't want the PE ratio to be any more than 20% of the industry average. And it's way lower, so we get 5 points here for the PE ratio. The forward PE ratio is 19.85. The industry's is 43.33. Again, that is a check mark in my book. Next, we have price to sales. So for Google, we have a price to sales ratio of 7.11. The industry average is 8.1. So it's under the industry average. Again, 5 points. Finally, we have EV to EBIT, which is enterprise value to earnings before interest and taxes. So this one, we have 18.26, industry average 25.65. Again, it's not more than 20% over the industry average. Check mark there, 5 points. So we got a total of 20 out of 20 possible points for our industry-based valuation, and we got a 100% peer valuation score or industry valuation score. So next thing we have is an industry-based profitability score. For this one, I'm using gross margin and net profit margins. I want to compare Google's gross and net profit margins to the industries to make sure that it has decent margins so that we know that it has decent profitability metrics. So what we're doing is we're seeing the industry average first of 64.45%, and then we have the actual of 56.90, which is what Google's gross margin is. It's a bit below the industry average, but what's good is that it is not less than 20% of the industry average. And since it's still pretty close to the average, Google still gets 5 points in this one. And in terms of net profit margin, it actually is even better. The industry average is 29.04% and Google has a 30.60%. So it actually gets 5 points there. The idea here is to make sure that a company that operates within a certain industry has growth that should be comparable to its peers. And so that is the profitability score, industry-based profitability score, and it's 100%. So moving on, we have the industry-based growth score. So here, first, I'm gonna go with revenue growth. So we wanna make sure that there is revenue growth no less than 20% of the industry average. So the industry average has revenue growth of 22.91%, and Google has revenue growth of 13.49, which interestingly, Google is actually gonna get some points deducted here because they're actually under 20% of the average of the industry's revenue growth. So only 2 points here. So let's go down to net income. So here we have an industry average net income of 16.22%, and actually Google is doing better than the industry average at 19.86%. So they get 5 points. Lastly, we have free cash flow growth. Now this one's actually not going up against the industry because it's hard to find data on the free cash flow growth of an industry. I wasn't able to find good data about that, so I'm just using this one as a general rule. Now Google has 22.49% free cash flow growth, so good job there. So anyway, we have a peer growth score or an industry-based growth score of 80%, which is very good too. Last thing I'm looking at is liquidity. I don't want a company to have too much debt. That's gonna weigh on its ability to make profits. So what we do for the liquidity score is, this is not an industry-based liquidity score, but I look at the debt to equity ratio, and for Google, it has a debt to equity ratio of 0.11, super low. I want it to be actually less than 2 is what I would prefer to have. And we get 5 points because it's under 2, it's only 0.11. So 100% liquidity score for Google. So Google's total score is a 57 out of a total possible of 60 points. Google has a RIM rank of 95%, which is very, very good. It got positives in every single thing except for one thing, which was revenue growth, and that's the only area where it got dinged by 3 points. So Google did a really good job in the RIM ranking. The next thing we're gonna look at is a discounted cash flow to see if what it's selling for is around the price that we think it should be selling for. So the first thing I want to look at here is the stock price. So the stock is selling for $2,685 right now. This is a free cash flow based discounted cash flow, and we're using 98.947 as the cash flow for Google, which you can see is over here on the trailing 12 month from December of 2021. Here we want to put a discount rate. There are different ways to calculate this. I'm just going to go with the return that I am expecting for Google. I would like to have a 10% return in the stock. Next thing I'm going to think about is the growth rates, which are extremely important in this situation. So for Google, growth right now, if we take a look over here, the past 10 years is grown free cash flow at 17.60%. Can it do that going forward is the question. I'm torn between this one because Google on the one hand is a giant mega cap company, and how long can it continue growing cash flows at such high rates of return? On the other hand, as you probably see, Google is an amazing company. So what I'll do is I'm gonna actually go through a couple of variations. So first off, we could say, what if Google hits its 5-year average free cash flow, which is 22.30%. So if we put that in here, 22.30%, and it hits that over the next 10 years, then Google is actually worth $3,980 per share. That's a margin of safety of 32.54%. I like to see margin of safety around 25% personally. Now let's go more towards the current 17%. We'll do 17.60% as a growth rate, which is what it has currently at past 10 years. And so if it does what it did the past 10 years, Google currently is pretty much fair valued. It's undervalued by probably just 4.89%. And if we want to go more conservative, we can go with a, let's say, 13% growth rate. And in that situation, so if Google does have a lower growth rate over the next 10 years, it's really only worth about $2,068 per share. So what do I think for Google? I'm torn on Google, but what I would say is, because I know that the company is a great company, great management, definitely has barriers to entry, so it's got moat potential. I think I might be okay with having a growth rate of 17% for Google going on another 10 years. At the end of the day, for me, Google is not a buy because it does not hit my 25% margin of safety. So then the question is, if I do have a 17% growth rate on this, what do I need Google to be selling for today? So basically what I did here was I just said, what if the stock price was $2,080? What would that look like? Well, now I have a 25% margin of safety with all of my different variables. So now I think Google is a buy if it's $2,080 per share. That's my price target. Let's see what's going on with Google technically right now. As of mid-December of 2021, as a lot of you probably know, a lot of crazy stuff started happening in the stock market. Google broke down through its uptrend line. So we had a false break in late December, went back up into the uptrend, another false break, back up, and then finally it was a real break through the uptrend line, and it went all the way down to 2005.12. That's what it closed on January 24th, and it has been gone up because it had a very good earnings call. So let's see the earnings real quick. Over a 10% surprise, so it had a very good earnings report, and because of that, it gapped up. Now, since then, they say gaps get filled, so it has been down quite a bit since then. Let's see, how much is it down since? So it's down 11% since that gap up. It's closed down below where it was before earnings. It's currently in a downtrend. So what are my thoughts on buying Google? Well, like I told you, my area for an entry to Google, or basically what I think is probably around fair value with a margin of safety, is really down here in the sub 2,100 area. Now from where it is selling today, that would equal another 17% down from where it's trading right now. Sometimes you just think that stocks are worth a certain price and you're not willing to pay more than that price, no matter what the chart even looks like. So if this thing even did bounce in this area, I still wouldn't want to jump into it because I don't think it's worth what it would be selling for. So anyway, that's all I have for this video. Thanks so much for watching. Hey, hit that like button if you liked it, subscribe to see future content like this, and watch another of my videos. It's coming up in 3, 2, 1.